third and final presentation. This will be LLJ Capital Advisors. And as they enter, hopefully everyone had a chance to enjoy the refreshments in the bar. Immediately after this presentation, you can join the networking reception again. The judges will have their final deliberation period, and then at 6:30 sharp, we will all gather back in the grand ballroom for the conclusion and the announcement by the winning team. So with that, it's time for LOJ Capital Advisors.
Good evening, ladies and gentlemen of the Investment Committee. We are your new associates at PE Shop, formerly at LLJ Capital Markets. I'm Lance Emerson. To my left is Josh Van Zandt. To my right is Luke Barber. We are here today to discuss investment strategy with concerns of Pearsco as a target for acquisition. We created several options for PE Shop to consider with these objectives in mind. Now, for these objectives, if you want to look in the back with appendices, to overview our data. Our objectives today.
Page 5 is where we're going to start here in your handout there, the objectives we're going to mention.
Our objectives today are to maximize PE Shop's investment return by possibly acquiring a partial interest in Pearsco or purchasing 100% of Pearsco and then taking it public. Second would be to maintain the core investment strategy of PE Shop. By this, we mean having a controlling interest Pearsco, or and actually have a clear exit strategy between 4 to 6 years. And our third objective would be to address stakeholder issues such as Pierce family's objections to our purchase and also concerns with our riders.
If you want to flip to the next sheet, we'll start talking about the first option. The first option is to acquire a 49% stake in Pearsco, a minority stake. At that value based at $140 million, we'd be taking a 49% interest in Pearsco. After 5 years, this is with an optimal debt capital structure, 1% SG&A, and 3% growth. We believe the IRR could be 6%. We would be investing $48 million of equity, and after 5 years, we'd extract $93 million of equity. You can see here some of the calculations used to support that, the cost of debt, the cost of equity, the WACC. But all that leads us to believe that in 5 years, in excess of 5 years, with $48 million invested, we'd be able to extract $93 million.
What do you have for your multiple in your exit here?
The multiple invested capital is 1.93.
What EBITDA multiple do you have for your valuation in your exit here?
We're using a 3.5% multiple for EBITDA. Are you talking about the multiple for what we would sell the company, the $93 million? I believe it is 2.5. Is that correct? So,
it's only 2.3. Today it's 5. You're walking into you and sell.
I'm probably spoken correctly there. Do you know what it is off the top of your head? No. And we didn't base it purely on EBITDA multiple. What we based it on is taking the equity we put in at optimal equity structure, seeing the synergies go for 5 years, and then if we are able to sell that entire portion, that 49%, what is the return on the capital that we invested at PE Shop?
That valuation is determined by through discounted cash flow analysis.
Yeah.
From our pro forma projected income statements through to the active period.
In doing this, there's some pros and cons in talking again about our objectives of doing this. We do get a much lower rate of debt. There's no need to refinance Pearsco debt. It's at a very low percentage. $63 million is at 6.5, but it does have several cons that come along with it. Obviously, the IRR 6% is below the 20% our hurdle rate, and it really differs from our core investment strategy. There's no clear exit plan, and it is not a majority or controlling interest, which you as investment committee have mentioned that the limited partners want to see because of our past bad experiences.
Well, under this scenario too, it's not going to satisfy some of the interests of the stakeholders in Pearsco. We know that Dan Pierce and Gina Pierce both wish to divest their 70% share in the company. And under this minority stake scenario, they may be unlikely to accept an offer we would make that would satisfy their desire
And also, there's an issue with Mark Rogers in some of the personnel acts. Piersco, with a 49% interest, it's very possible that those would be hurdles to really exploiting the synergies, and it could really prevent the synergies from taking place, making its value lower. So there's a lot of cons associated with the minority interest.
Yes, minority interest, you get a cost of equity of 11.75.
Yeah, if you refer to the cost of equity, it's using a CAPM, a unlevered beta for Piersco, which we know we for the industry, we re-levered with the debt equity ratio.
And you just use the median and
We actually use the median, yes, and we use all comparable companies, including Charter Communications, which is now there.
There's like three or four companies in it, and it's extremely high net, and if you use like a Hamada formula or something like that, I think that unlevered beta might be understated.
Well, we did use the unlevered for the entire industry because of the fact that we felt some of the risk involved with those companies, some of those levels of debt are representative of the risk of operating in that space. So we felt it may be incorrect. We used the median, not the mean. We felt it might be incorrect to just discount some because they had a strange capital structure.
Yeah, I guess my concern is that if the cost of equity is still extremely low for minority investment versus IBM or a large cap company might be okay. This seems very low.
We did add an alpha, a risk premium, roughly not equity risk premium, but in this case, beside risk premium, possibly, or just an alpha of roughly 6%, 5.82.
Understanding the interest of time, are we spending time on what is not your recommendation, or is this your recommendation?
Correct, this is our recommendation.
I'd like to see what is your recommendation.
But we can proceed to option B, which we'll discuss as well.
Our next option we're going to consider, converse to minority stake would be a full 100% acquisition of Piersco and merging it with our portfolio company. The end goal of enjoying some synergies in cost of goods sold and SG&A. And our baseline, we're looking at 1% synergy in cost of goods sold and 3% synergy in SG&A. Here with invested capital of $30 million. The portion of equity that results from in our investment in Piersco after an exit strategy of 1 year or near-term exit with an IPO, we're looking at around $66 million with a pretty substantial return IRR of 120% and multiple invested capital of 2.2. Now, when we consider this option, there are significant pros. Obviously, namely, it exceeds our hurdle rate of 20%. So, but we also are maximizing our return while kind of eliminating some of the downside risks and the difficulty we would encounter in a minority stake and really being able to enjoy some of the synergies that could be based on.
Yeah, I mean, we need to temper some of the excitement with such a high IRR with some of the feasibility of this actually occurring. This is based on if we're actually able within 1 year to exploit those levels of synergy, which is a very, very short time for us to actually be able to show demonstrable results in those levels of synergies. So if we are able in that short amount of time to take on more debt, to show the effective leverage, and to show those synergies, that would be the IRR. However, we think that might be a slightly longer time horizon needed to do that, but the quicker generally the better. Also, another thing we need to temper this with is the feasibility or the excitement in the IPO market right now. Really, the data, the information we have for the IPO markets from the underwriter of our firm is very, very excited about the current IPO market. It's somewhat biased in an opinion, but we've seen that some of the IPOs in the first quarter of this year have been canceled, and so we're a little bit concerned about that. However, if we are able to do it, and we are able to show the synergies, that would be the IRR.
Sure. Josh, you mentioned certainly the ability to complete the IPO in 1 year time. Well, we've also considered going to 5 years as well, because you see, we use the same synergies and the cost of goods sold and SG&A, but our IRR drops to 22%. Here we keep the same capital structure at 60% debt, and we have a multiple of invested capital at 2.6 to 7%.
We're basing that capital structure on an industry average. What's kind of the acceptance capital structure is debt as a percentage of the capitalization is 40 to 60%.
Yeah. If you want to flip to page 12, flip to page 12, we're going to talk about the optimal capital structure and why we are choosing, in situation A, we chose 55% debt, in situations B and C, we chose 60% debt. Now, why is that the optimal debt level of capital? In situation A, 55% debt A, is bounded by the limits of the transaction. We cannot raise more than $98 million in capital. That's bounded by the 3.5 times EBITDA. Also, even if we were able to raise more than 55% debt, as you see, option A, the returns would be much higher, but Piersco would be unable to service the debt. So it is not a feasible level of debt. So that is why the IRR, which is what these numbers represent, is 6% for that. For option B, now you can see the advantage of adding more debt is that we do get higher returns, but it's a more volatile cash flow. You see at 65%, we actually have a negative number and extremely high IRRs. There's unnecessary volatility because of the negative, because of the leverage. That is why we selected the 120. Additionally, the 60% debt rating, or debt weighting that we have is based on the industry average. Most of our competitors, the mean is actually 60% level debt. However, even though that's the average, we would still consider that the roof of where we would want to put the debt level. Just because of the fact that the two companies that are actually showing positive net incomes, turning a profit in this space, AT&T and Comcast, only have a debt level of roughly 40%. So we'd be even wary to go up to 60%. But with these attractive returns, we think that the 60% level of debt is up. And the same thing goes for option C. It's the same structure, it's just way longer. And you can obviously see the decrease from option B to option C shows you that if you are unable to complete the IPO, your IRR goes down precipitously.
There's several other issues that we want to make sure that we consider too in either scenarios when we're making a 100% acquisition of Piersco. One being the covenants in their current debt, $63.6 million, would require us to refinance that in terms of a blended rate of 6.5%, and we'd be refinancing that around 14%. So we need to consider that under these scenarios that our cost of funds is going to go up significantly.
Yeah, and that is one of the cons. But there are several pros. Obviously, these are high IRRs for particularly the short-term IPO. The long-term IPO still has an IRR above the hurdle rate, so that's positive. But there are some additional positives. It does maintain our core investment strategy, which is a clear exit, and it is a controlling interest in the company. In addition, we're able to satisfy some of the stakeholder issues in this, and in our term sheet that we built in, it's in the appendices, we have a plan to be able to keep Dan Pierce around as a figurehead, as for continuity's sake, and for possibly some expertise we can satisfy that way. Also, the issue with Mark Rogers and his team could be satisfied, we can extract synergies, maybe a little bit easier. So there's a lot of positives associated with it. However, there is the additional risk that if we don't see these synergies, our IRR could be negative or could be much lower.
One thing I don't understand, on the 1 to 5 year scenario, you have different enterprise values, and it seems like the synergies are the same. And then in both cases, the investment capital is, what we're putting in is 30 million, is that correct?
That is correct. And when
you get to the 30, if we start with 201, in one case, 215,
that enterprise value is the enterprise value of Piersco. It's not the enterprise value of total combined co, because we're trying to find the multiple invested capital that we put in. And we run aware of the capital that we put into portfolio co. So we just know the capital that we put into Piersco. So putting money in equity value in Piersco, combine them and extract them at the end. What is the equity? The overall enterprise value would be much larger, but the portion from the synergies in Piersco would be 201. And that's not just the equity value, that's the enterprise value including the capital debt. The equity portion would be the 60.
but our investment is going to be
30 million in equity.
And so if I take 30 minus the 201, or there's 170 million in debt,
No, what enterprise value of your stage 8 would be 201, 66 that would be equity, 140 would then be debt. What the invested capital is, the original invested capital was 30 million, and then it grew to 66 million, and that's that. So our equity went from 30 to 66. At the end, when we took out the 66, the total value, total enterprise value would be 201. So that would mean,
so the 201 is, the 201 is original, this is the original enterprise value.
no, it's the debt plus equity at this time, which is 1 year.
Those enterprise values are at the exit.
Okay, because it's on some pipeline.
Yeah.
Yeah, no.
Call this